Welcome to CropCast, a series of monthly Arable podcasts bringing you the latest information, timely updates and expert advice. In today's episode,
the increased demand for borrowing has rarely been as high as it is now. That's very much the feeling that I'm getting from the finance industry. It's being proactive, it's approaching your lenders in advance before the problems arise. That's going to give you the best possible chance of having a positive outcome.
Obviously, I'm not Tiffany Stevenson. My name is George Chalmers. Tiffany is currently on maternity leave, and we look forward to seeing her return in the near future. In this episode, we are talking to Andrew Coalter, who's a senior consultant and area manager with SAC Consulting, working out of the Perth office. We'll be looking at the current financial climate for arable farmers, covering, amongst other things, cash flow, borrowings, and taxation. I'm joined today by Andrew Coalter, who is going to be talking about financial considerations for arable farmers. Now, Andrew, your journey to becoming a farm consultant has been slightly different from the rest of us. Would you like to tell us all about it?
Yes. Hi, George. Thanks for having me on the podcast. So I'm originally from a beef farm in Northern Ireland, but rather than taking the traditional route into agricultural consultancy, I actually spent a number of years working as an accountant in practice. So within agriculture, I worked with agricultural businesses across the Central Belt and Fife, which is the same area that I now cover as an agricultural consultant with SAC. So a slightly sideways route to get into consultancy, but I've still made it here all the same.
Yeah, now you're getting to grips with all sorts of things like IACs and EECs and all the fun that goes with that. We're going to be talking about what arable farmers need to be thinking about in a financial sense this winter. It's not been it's been a challenging year. That's been kind of the fairest thing to say for arable farmers. It's been good yields, certainly in the winter crops, but the spring crops have probably been left a lot to be desired. And this is the backdrop of input prices rising. What are you seeing so far, Andrew?
Yes, you're absolutely right. The view from many farmers in my area, but also across the country around their harvest is yields and quality are mixed, particularly when it comes to crops like barley. Getting those crops away at a good price is particularly difficult at the moment, and that's putting pressure on businesses, particularly in terms of their cash flow and being able to plan for that. We're seeing a lot of businesses around that are either having to sell barley for feed at a reduced price or incur a lot of additional costs to get that barley screened in a way to meet spec. So there's a lot of extra costs involved, which is really impacting, cash flow and ability to plan going forward.
Well, obviously, a lot of arable farmers, they have become used almost to selling spring malting barley, generally making the grade, and they're used to seeing that money coming in September, October time, in tandem with the single farm payment in recent years. That's got to have a big effect on some of these businesses.
Oh, it does. It has a massive effect. And actually what we see is a lot of arable businesses structure a lot of their other costs around these pay points. If you're used to getting your payments in September or October time, traditionally a lot of these businesses will have expenses that go out around November or December, whether that's annual payment for machinery hire purchases, whether it's payment for fertilizer or other bills as well. So if there's any delay in the income to that business, it has knock-on impacts on the ability to pay out the costs on the other side of that. You're absolutely right.
Yeah, and I think it's also important to say as well that a lot of farmers are maybe sitting with, the grain in the shed. It's not moved off the farm. It obviously still has quite a considerable value. They've also to take a strategic decision. It can sometimes be quite easy just to sit back and, they may be busy with field work and things like that. And the cash side of it and the profitability side of it is maybe at a wee bit at the back of their minds. But in the wider business, it's maybe tying up space. It's maybe impacting on another sector. The cattle, they kind of get the cattle inside. Maybe they're suffering a bit as well. So they've really got to start maybe thinking about planning out sales, not just for cash flow, but also for how it's affecting the wider business.
Absolutely, absolutely. And we're actually seeing that impact as well in the store sales this winter. Store sales have definitely strengthened, and a good part of that is due to the availability of cheap feed. So while it might be good news for livestock farmers in the short term, it's posing challenges for arable businesses. I'm definitely hearing reports on the ground of arable farmers who are getting back into keeping store cattle again that maybe haven't done so for a number of years, on the thought process that they might make more profit sending that grain away as a fat animal rather than sending it away as grain in the back of a lorry. That is a strategy that can work quite well, but again, it just delays that cash coming into the business. It can cause problems if you don't have the resilience, to withstand that extra delay in the money coming into your business.
I think it's also important to remember that you need infrastructure in place as well. Whether even if it's just feed bunkers and gates and facilities, it's and a cattle. There's a big cost with the cattle as well.
Yes, yeah, there is. There's plenty of costs associated with that too. Cheap feeding is one thing, but if you need to be able to harbour all the other costs that are associated with that too. It shows that some farmers are starting to think ahead. There are opportunities, diversifying your income from that grain, whether it's through the introduction of livestock, but it's making sure that your business is resilient enough to handle the demands on it in a year that can already be quite taxing from a cash flow perspective.
This is probably as good a time as any probably to look at your business and even business timings and payments and when you buy things. As they say cash is king at the end of the day. A lot of folk will be looking to buy fertilizers, and often that's to be paid soon after it comes home. So there needs to be a lot of thought given this year.
Yes, there absolutely does. There absolutely does. I think we're in a strange situation where particularly to focus on barley again, the price hasn't been fantastic for the last couple of years, where the price that you're getting for your end product, if compared to the cost of production, in many cases is leaving little to no margin. Some farmers in reality are going to need to review their costs and consider if it's worth growing spring barley next year. If that's a decision people come to, you also then need to give consideration to the cash flow implications of changing your rotation and what that looks like. As you mentioned, George, if you're used to getting that grain check at a certain time of year. I suppose speaking to bank managers that I deal with, the increased demand for borrowing has rarely been as high as it is now. That's very much the feeling that I'm getting from the finance industry. Interest rates have pulled back a little bit. That is helpful. So from August 25, the Bank of England base rate dropped to 4%. For agricultural loans at the moment, typically you're looking at a borrowing rate of base plus 1.5% to 3%. Typical borrowing rates would be around sort of 2.5% to 3% over base. So you're looking at financial borrowings of around 7% at the moment. So considerations need to be made on that front.
Yeah, and if a farmer is sitting with he's sitting with a grain in the shed essentially, and you can there are reasons why farmers don't want to sell grain early. They can see an uplift in the market. They can follow market reports. They can see it. Things are maybe going to improve in the new year. They've got the storage, but cash could be tight for whatever reasons. What are their options at the moment?
So the first thing that everyone should do is sit down and look at your numbers. Create a forecast for the months ahead, for the year ahead, and create a budget for what's going to come as well. Face the issues up front. That's the best thing you can do with any sort of financial planning. When you are creating a forecast for the year ahead that is to come, make sure that you are including absolutely all of your costs. On top of that, stress test your business as well. Don't just put in figures on wishful thinking. Any sort of good forecasts should include the downside scenarios that might occur, not just the best case scenarios that you hope should occur. Getting a handle on what your costs will be is really important and is absolutely crucial if you want to make, sensible plans for the months and the year that lies ahead that are going to stand up to some form of scrutiny. So if you don't want to be forced to sell your grain at the worst time, there are a number of options available to you. The first option is that you can speak to your bank manager. The earlier you do that, the better, is always the case. There might be opportunities there to temporarily extend your overdraft if that's something you need. There will be opportunities to look at perhaps converting some of your borrowings to fixed term loans or other financing options that are available. It's also a good time to just look at your costs in general. Are there any costs in there that you could delay? George, a good one that you mentioned already was fertilizer purchases. Can the fertilizer purchases be delayed by a couple of months until they're needed? Is that a possibility? Can you speak to your suppliers and discuss lines of credit that they offer in terms of being able to give your cash flow a bit of a break for an extra month or two? What we also find at this time of year is that many arable farms will have set aside some budget for routine maintenance and repairs. It might be the case that you can tighten the belt on that front perhaps for a year just to take the pressure off your cash flow as well. So there's always lots of options available.
And the last few years have been pretty good for arable farmers, and most of them will have invested. A number of them, and probably will have been using hire purchases for their, to invest in the business for new machinery and what have you. Is the best option there to speak to hire purchase companies?
Yes, absolutely. Again, the earlier you can do this, the better. That's always the case, whether it's speaking to hire purchase companies or your bank manager or whoever it is. If you're proactive and approach your lenders for an honest discussion, it will generally be viewed in a positive light. It's the businesses that ignore the problems until it's too late and perhaps you're already at your overdraft limit. That is where I generally see the issues arising. In my experience, banks and lenders generally want to work with farmers and support the businesses that they're lending to. But if you leave the issues for too long, then affordability of borrowing becomes a real issue and the problems become harder to resolve. If you speak to lenders, you mentioned in particular, financiers for things like hire purchase, quite often there are opportunities available under your contracts for taking payment holidays. That might be on a monthly hire purchase, you might be able to take a holiday for 6 months or maybe one of an annual term. But again, it's being proactive, it's approaching your lenders in advance before the problems arise. That's going to give you the best possible chance of having a positive outcome.
This can also be a good opportunity to have a look at machinery pools. Machinery is a huge cost in an arable business. Is it a chance to just go through what they need, what they don't need, look at the back of the sheds, etc., and just actually have a look at their machinery pool?
Yes, you're absolutely right, George. Machinery costs make up such a large proportion of the direct costs in an arable farming business. This is a great opportunity to review that and to see what you could do differently and to review your costs. Is there anywhere that cost could be saved or capital potentially released, as you've suggested too? There was quite a good CropCast episode released recently which talked about machinery replacement, where you should be doing a review of your costs to see actually are there things you could cut out. It might actually be the case that putting off investment isn't the right decision. It might be that repair costs associated with your current kit outweigh the value compared to investing in something new. So it's not necessarily that we're saying you should look at machinery and see what you can cut out and see what you can do less. Absolutely not. But it's taking a pragmatic view of the costs that you do incur year on year based on known information to take an informed view of how you can reduce that cost base going forward. There's definitely opportunities there for businesses to have a look at that and perhaps reduce some of their costs that they have.
And while we're looking at costs, machinery, and cash flow, for people maybe who are looking at other projects, and from time to time there's an opportunity to expand, and that'll still be on people's minds, some farmers' minds. Um, what's the lender's attitude at the moment to lending?
In the marketplace, it seems to be the case that banks are quite keen to lend to agriculture. It might be the case that some banks are keener than others, but there are definitely opportunities to be had out there with a number of lenders, perhaps some of the traditional high street banks that you know of, but some of the newer lenders in the market as well are pushing quite hard to lend to agricultural businesses. So there's definitely an appetite out there for lending to agricultural businesses and confidence in the agricultural industry from the banking sector. So that's a good sign. The fact that interest rates have been cut slightly helps. At the moment, looking at the financial outlook, there has been some upward pressures on inflation. It is anticipated that inflation is going to stick at a similar level for a while, not really hitting our 2% target until around 2027. When that translates into interest rates, we're not expecting any more cuts for another while. There are lots of uncertainties in the markets, whether that's inflation, global politics, all the rest, but there are definitely opportunities out there for those who wish to expand to seek finance and to seek finance perhaps from institutions or lenders that they maybe haven't dealt with before.
Yeah, it was interesting that you mentioned about repair costs, and how they may be getting too high for one particular piece of equipment. Even if the current maybe trading conditions aren't brilliant for arable farmers, it's important not to neglect investments in equipment and even infrastructure.
Yes, definitely. You need to consider your ongoing costs as well. Infrastructure is one of these things that often gets overlooked, particularly as farms expand. It's often the case that I see, farming units have expanded, they've maybe bought the neighbouring unit, but the sheds that they're working with are still creaking along and haven't maybe got the investment that they deserve. So these decisions still need to be made. There are significant tax advantages of capital investments as well that can boost your business from a taxation perspective, that can help swing these decisions. So it's not to say that in a year where cash flow is perhaps a bit tighter, that you have to completely shut down new investment decisions in whether that's in machinery or infrastructure. These projects can still go ahead with a bit of careful planning.
And we're about halfway through the financial year, but it's always worth doing a bit of planning, and a lot of farmers will have some sort of tax obligations coming up in the next few months. It's important to remember, we talked about the cash flows. It's important to remember that you've got a wee bit left over for that.
Yes, you're right on that front. We talk about, tightening cash flows, and we still have the opportunities to invest if it's done correctly. Whatever you do, don't forget the necessary evil of tax payments that you need to make at the end of January and at the end of July each year. Those obligations still exist, and in discussion with your accountant, you should hopefully be able to get a good handle on where that is and how much you expect to need to pay out when you're forecasting your figures. There is opportunities available there. If you find that you're having a particularly poor season at the moment, when we reach the end of this financial year, there will be opportunities available to sole trades and partnerships under what's called farmers averaging. That's where you're able to average your profits over 3 or 5 years. And it might be the case that if you've paid higher rates of tax in previous years and now you're in a lower tax profit position, you might be able to average some of that out and see some of the benefits to your tax payments that you have to make. But very much be in discussion with your accountants around these points and make sure you don't forget that these payments are on the horizon.
So what is described as capital expenditure, and what would just be expenditure in a set of accounts?
Yeah, so that's really important from a tax perspective, is knowing what the difference between capital expenditure and revenue expenditure is. So capital expenditure is the purchase of, fixed capital items. So we're talking about equipment or investment in new infrastructure. These are costs that you're not able to recognize within the profit and loss within your accounts. They're not directly allowable expenses for taxation purposes either. On the other side, the revenue expenditure, that relates more to repairs and maintenance. So you're looking at repairs of equipment or repairs of infrastructure, providing you're not actually enhancing the value of it there. Replacement parts on a like-for-like basis would come under revenue expenditure. Basically, we're looking at normal wear and tear, and the repairs that are associated with that. That comes under revenue expenditure. From a taxation perspective, classifying as much as possible as a revenue expenditure is beneficial because it's a fully allowable expense for taxation purposes. We don't need to worry about capital allowances. It's just taken off your profit. But if you have any sort of investment in new equipment, if you're investing in new infrastructure or upgrading existing infrastructure, we then look at the capital allowances from a tax perspective to see what tax relief we can get on those investments.
So, Andrew, when people are making capital investments, it's important to understand that there can be various allowances that can help reduce the cost of those investments. But one of the crucial things is that you understand them and also your accountant understands them to get the best of them.
It makes a really big difference, George, when you're looking at investments, particularly in infrastructure in your farm and business. We're using a set of reliefs that apply to all businesses, but it is important that you and your accountant understand the intricacies that are associated with agricultural businesses and how to apply the rules to these scenarios. The main capital allowance relief that we often talk about is known as the annual investment allowance. It's effectively the main 100% write-off that farmers think about when we're talking on capital allowances, where you can buy plant and machinery up to a value of £1 million per year that can be fully written off against your taxable profit. I'll be honest, that's a big driver of machinery sales within the UK and has been for a very long time. If you trade as a limited company, it goes a bit further than that. Limited companies get what is called full expensing, which means that they can write off up to 100% of the cost on expenditure on plant and machinery, but there's no limit in the same way that sole trades and partnerships are limited to that first £1 million of investment. If you are a traditional sole trade or a partnership, which accounts for the majority of Scottish agricultural businesses, and you go over that £1 million allowance, or you have investments in plant machinery that don't qualify for it, we then have reliefs in what's called the main rate pool or the special rate pool at 18% or 6%. So there's lots of reliefs there on investing in plant and machinery. What often gets forgot about is the reliefs that are available for investing in infrastructure, as we've discussed about. So we have what is called a structures and buildings allowance. Now, this was introduced back in 2018. It's quite similar to the old agricultural buildings allowance relief of 4% that existed about 15 years ago. But rather than getting 4% a year, we get a 3% relief on any qualifying purchases in a straight line basis. So that covers investments in sheds and infrastructure on farms. So that covers a lot of things that previously we might not have been able to get relief on. Obviously at 3%, that's a much lower rate of relief. So the priority is to maximize the amount of expenditure which can be classed as plant and machinery rather than as classed as structures and buildings, if that makes sense.
Yeah, I think as well, after a year like this, obviously things are different. There's a lot of farmers, their storage has been tested. They've had to try and lay their hands on a grain dresser if they haven't got one, so some of them will possibly be looking at that as a future purchase. And even the dryers, there's been more pressure put on them because they've had to dry them down to grain down below 14, just so that it can be safely stored. So there may well be this could be a year that folk are looking at, different capital expenses, and from what you're saying, it's really important that you look at all your opportunities, really.
Yes, you're absolutely right. You mentioned a good point in terms of grain storage. That makes me think of a few interesting cases that came before the courts. So for capital allowances, it's all based on tax legislation, but it's backed up by case law. Any uncertainties are cleared up in that way. So there's been some really interesting distinctions made specifically for the agricultural industry when it comes to the distinction between what is a structure and building and what qualifies as plant and machinery. It's these scenarios where having a knowledgeable accountant in this area of tax legislation makes a significant difference to the amount of reliefs you can get available. A really pertinent example for arable businesses would be around grain storage. If you can prove that your investment in a grain shed performs a function rather than just being more than a mere shed, just being the setting for where you carry out your activities, then it might be possible to get the 100% plant and machinery allowances on some of that investment. I don't know if you watch many agricultural YouTubers at all, George, but there is a guy called Tom Lamb down in England, and he documented his process on YouTube of how he built his own grain shed. And what he'd done in that process was that he incorporated the grain drying fan pipework as an integral part of the shed. It was actually concreted into the floor. What that meant was that it's no longer just a shed. That shed actually performs a function. It's an integral part of that drying process. So actually, he should be able to claim capital allowances on a much greater proportion of the shed rather than just on the drying infrastructure itself. So that can make some really interesting differences. There was quite a big court case around that in 2019 where a farmer was able to successfully argue that the grain store qualified as plant rather than just being a structure, and he was able to argue that the whole structure was required for airflow because it incorporated his drying equipment, his air extraction, and everything else, and he got 100% allowances on the full structure, not just that 3% per year.
Yeah, that actually then means that, if you are thinking of investing, think about what you're building. I think is the key there, and it actually makes actually makes good sense for a grain store to have plenty of ventilation, and so it's like rather than just a bare concrete floor.
Yes, absolutely. The fundamental distinction between setting and apparatus is central to most of the cases that we see in terms of the identification of plant. Now, a lot of these cases were settled back through the courts in the 60s or 70s or whatever it may have been, but we have seen a number of interesting cases, particularly over the last 10 years, that relate specifically to agriculture. Another quite interesting case within the last 10 years came around a potato store. A farmer built a specifically engineered shed. I think it cost him around £300,000. To compare that to an ordinary shed of a similar size would have only cost him around 50 as a general purpose shed. It was considered to be an integral part of the activity rather than just a setting. And again, he was able to get full capital allowances as well. If you are considering sort of big investments, it's worth getting the right advice to make sure that you're able to maximize some of these reliefs that are potentially available to you.
And Andrew, energy prices, go, some years they've gone through the roof. Do renewables, do they qualify for capital allowances?
Yes, some investment in renewable can qualify for capital allowances, but they need to be considered independently. So, for example, if you wanted to invest in solar panels to put on a shed roof, that would qualify as plant and machinery. They wouldn't qualify for that 100% annual investment allowance, but they would come under what's known as a special rate pool. So you would get 6% per year on those solar panels. That's actually quite a good example of how we need to consider an entire project in its component parts. We can't just say you're building a shed, you're building a grain shed with solar panels on the top, therefore it all gets the same rate. Absolutely not. We need to go into much more detail for that. And HMRC will scrutinise these claims in much more detail and break them down into their component parts to make sure that you're claiming the right amount on each element of these projects that you undertake. That can work in our favour. It can mean that while a structure may only get 3%, many of the component parts can get much higher allowances than you might first think.
Okay then, Andrew, to sum up, what are your 3 top tips for listeners?
If finances are an issue for your business, plan early. Speak up early as well. It's really easy to stick to the day-to-day farming and perhaps sideline some of these financial planning that we should be undertaking, but be upfront and tackle any problems that you have head on. That's the best course of action that you can do. Review your expenditure. See if there's anywhere that you can cut costs or perhaps delay costs. That can make a really big difference for your cash flow forecasting going forward, particularly if you think you're going to have issues over the coming months or the year ahead. I suppose finally, from a tax perspective, make sure you have an accountant that understands agriculture. Unfortunately, I've come across a number of problems in recent years where people have perhaps taken bad advice, and that's not really on the part of the accountant. It's just that they didn't truly understand the complexities of the industries that we work in. And if you are planning expenditure, include your accountant in that process to ensure that you're maximizing the tax allowances that are available to you.
Thanks, Andrew. Thanks for joining us today and giving us a really in-depth view of some of the financial challenges that are facing arable farmers, and also some of the planning and considerations that they can have in the future.
Thanks very much.
Thank you for joining us for this episode of CropCast. If you've enjoyed this podcast, please subscribe or follow. If you want to find out more about anything we've discussed on the show, or you'd like to get in touch, you can find all our details in the show notes. If you've enjoyed listening to CropCast, you may enjoy some of our other podcasts, such as Rural Roundup, with one of the latest episodes featuring Peter Lang from SEPA, who provided an update on the new regulations for the application of waste to land. So why not go and have a listen? Look forward to seeing you again for our November episode of CropCast. This episode was hosted by George Chalmers, produced by George Goley, and edited by Cameron Waugh. The podcast is produced in association with the Scottish Government.
The Farm Advisory Service Podcast. Audio advice on livestock, crops and soils, environment, rural business, and more. Brought to you in association with the Scottish Government.